Thank you, everybody, for listening in. This is the first in the Finance Friday seminar series sponsored by the Cutler Center. So thank you to the Cutler Center for giving us this opportunity to talk about the financial impact of the current crisis caused by the coronavirus or COVID-19. Today, I'll give I would say more of an overview and talk about the policy response, the government response in the face of a crisis, and I'll make some links to the 08-09 financial crisis, as there are some interesting lessons to learn, and clearly the current administration is also making good use of the lessons learned from the crisis. So my name is Jerome Taillard. I'm an associate professor at Babson. My email is jtaillard1@babson.edu. Feel free to email me after the presentation with any follow-up comments and whatnot. And okay, I cannot hear you, so I apologize. For those, George, can you hear me? Yes, okay, so I apologize for those who cannot hear me. I believe we've done a trial session, and I apologize if not everybody can listen in. Hopefully most of you can listen in. Rashi, can you hear me? Yes, yes, okay, thank you. Patrick also? Okay, so let's go. Just in case there's a problem with Zoom, we will have a backup on WebEx. So, and Leslie and Farah will send you a quick email if ever that was the case with the link and we would switch to WebEx, but hopefully Zoom will handle this well. Again, we've muted all microphones for now, so don't hesitate to ask your questions through the chat during this presentation, and we'll follow up with the Q&A. So, Black Swans, just a bit of terminology. Nassim Taleb made this term popular after the 08-09 crisis. A Black Swan event is a rare event, an outlier, which has extreme impact, and in retrospect has predictability, though not prospective. It's kind of, with the benefit of hindsight, we should have seen this coming. And he used that to describe the financial crisis of 08-09. As we saw, there was a huge buildup in exposure to real estate market and other mortgage-backed securities and colorful financial products that created a gigantic credit risk in the banking sector, and that is what led to the crisis at the time. And so, are we in a Black Swan event? Well, it seems like it. Global pandemics are rare. It's a novel coronavirus. Nobody's immune to it, so it is kind of ravaging the world in terms of its impact. And the impact is huge, not only obviously on the health impact, the immediate impact of contracting the virus, but the economic impact that we are seeing unfolding in front of us. And retrospective predictability, kind of. We were warned. Many people in the medical sector have rung the alarm for now years that we are not prepared for such a pandemic. And so, you know, I think it qualifies quite well as a Black Swan event. So we'll see today how the government is dealing with this. And it certainly was not something we saw coming. This is an interesting survey data run by North Carolina State University, ran actually late last year, surveying a top 1,000 risk managers and CFOs. And you see obviously no coronavirus on the list, but certainly an interesting increase in people fearing economic policy and conditions. And so that there were macro clouds already on the horizon, and this pandemic obviously adds tremendous stress on a situation that was already kind of showing a few cracks out there. And so, just taking it back literally 500 years, the world, as we know it, has changed dramatically over time. And the growth that we've witnessed is just absolutely tremendous. So the good old days were only good for a really handful of people on Earth. Luckily, we were born in this time, and we benefit from tremendous economic growth out there. But the road is bumpy. The road to growth has been bumpy, and that's what we call business cycles. They come at regular intervals where basically the overall economy contracts and unemployment falls. And so the Great Depression changed a lot of economists' point of view. This was when Keynesian economics were born. Basically, Keynes realized that the economy is not self-correcting, and the lack of spending and the fear at the same time with high unemployment really doesn't self-correct. And the solution that we've recognized to be a good one since then is government intervention, in particular on the front of fiscal and monetary policy. And so those are the two pillars that I will talk about today. How do governments impact us? I think it's important to recognize, as I was preparing this material, in how many ways governments set the rules of engagement. Monetary, yes, they issue currency, they deal with inflation, interest rates, fiscal, taxation, government spending, regulatory, legal, the rule of law, but obviously then governance, the governance of countries, financial development, healthcare, quite important right now, education, infrastructure, energy. So governments matter a lot. And I'm going to start off with fiscal policies and who's in charge of that? Well, basically the legislative arm and the executive arm, at least in the US. So Congress and the Senate, there's bills that are being proposed. They go through a whole process, and are signed off into law by the president. There's also the budget. The budget proposes the president proposes an initial budget. It goes then through the chambers, the Congress, Senate, resolution, reconciliation, appropriation. It's messy, but it's how it is, and lots of checks and balances. The president can circumvent, in some cases, the legislative arm, and we've seen him, Donald Trump, we've seen him do that with the trade war that he's put in place with China. And so there's some interesting back and forth here in terms of fiscal policies and how they come about. And then there's the US Department of Treasury. And again, I'm focusing on the US right now, and I'll talk a bit about what's going on around the world. Obviously, you have the equivalents in many countries around the world. And so Department of Treasury, run by Steve Mnuchin, who until recently we didn't hear about too much, but now he's in the middle of the crisis, exactly like Tim Geithner was during the Obama administration when they picked up where the crisis was at its worst in 2009. And so the Department of Treasury enforces finance, tax laws, makes sure they collect taxes and whatnot, but also makes sure that it can put in place policies to maintain a strong economy. And in a time of crisis, that certainly involves having to intervene in the market. So I realize I'm just seeing that we have reached a max of 100 participants. I appreciate the message, and I would love to be able to do that. However, I'm not sure I can do that right now. Let me see if I can do that. Yes, I think what we're going to do is just go ahead, and I apologize for those who are trying to reach in, but we're recording the session, so we will post it afterwards. And again, I apologize for the capacity constraints here. We will sort that out for the next sessions. But again, all of this is recorded, and so you'll be able to see these slides afterwards. Okay, so back to the presentation. Fiscal policy in what's going on? Well, you raise funds, and that's taxes, and you can kind of see the breakout here. And then you spend the money, and government spending goes across different buckets, like social security, education, the military, Medicare, Medicaid. These are the big buckets here. Interest payments also on the debt. And how does a fiscal stimulus works? Well, indirectly, you can simply reduce taxes. Okay, and if you reduce taxes, then this allows for an increased demand for goods and services, and then you can also stimulate the economy directly, and that's what we're seeing right now with the bills being passed, where we're literally going to increase spending and helicopter money, literally sending checks to people, spending on infrastructure, military. All of these are direct stimulus. One issue here potentially, and it's been a lot in the news, is the time lag, because again, you saw the Congress, Senate, presidents, all of them have to kind of go through these bills and pass them into laws and then implement them. So it does take time. And you see, however, that when they are implemented, like in time of war or during the financial crisis in around 2010, you have big spikes in budget deficits. That is the government trying to prop up the economy. With permanent deficits, of course, debt goes up. There's been, I would say, a broad acceptance of running deficits, especially if it is during a time of crisis. And so that's an interesting comment. And I'll just mention in 0809, there's been a lot of studies since then. I would say a decade of economists have poured over the latest, the Great Recession. And it's pretty clear that if there hadn't been a fiscal stimulus, it would have been much worse. And so there's been this broad acceptance that when in crisis, fiscal discipline might not be the right solution, just like Keynes had suggested for the major crisis back when. There's other ways that the government can also come to the rescue. And there was famously, the US government took a large stake in GM and basically offered 50 billions in loans that were converted in equity, given majority ownership of GM to the government. It lost about 10 billion in the transaction after they unwind the position. But interestingly, the unemployment in Michigan went down to 4.5% by 2016, which was below the national average at the time. And so these unconventional measures can be very successful, and we'll see the other unconventional measures that are taken on the monetary front. So the monetary policy is set by the central bank. In the US, it's the Fed, the Federal Reserve. Jerome Powell, the other Jerome, is the current chairman. You are familiar probably with the former chairman, Janet Yellen, Ben Bernanke, Greenspan, Paul Volcker. Pretty famous given the importance. They regulate many things, including money supply, currency. They influence the borrowing costs and the liquidity of markets. The famous FOMC meetings that occur 8 times a year is where they set the short-term Fed fund rates, which determines the borrowing cost for banks, at least in the short term. And whoops, sorry, I apologize. What's important to realize is that there's typically, we talk about the dual goal of central banks, which is typically maintaining low unemployment and price stability, so low inflation, 2.5% target right now in the US. And again, although this is the US example, many central banks around the world have similar objectives. And now, if I see what they do in a time of crisis, so again, looking at the 08-09 crisis, you see very clearly on the figure that the Fed immediately lowered in 2 major steps the interest rate, the federal fund rate, to lower the cost of capital for firms to try and boost the economy, make it cheaper, make it easier for lending to happen in a time of crisis. This is an extremely powerful tool, and so there's always this worry that the central bank needs to be removed from politics as much as possible. And you've seen interference by Trump in the last few months, putting pressure on Jerome Powell and his team to lower interest rate to boost the economy, but it should be used sparingly, given how powerful the tool is. And so this is one way that the central bank can affect the economy. The other way that you see central banks affecting the economy is through what we call quantitative easing, or QE. And we've had a lot of that since the crisis, both in the US and abroad. And you see again with the figure on the left that what happens is that the central banks can issue money by basically purchasing collateral, typically Treasury. Traditional security holdings are Treasury bills, and in exchange issue dollars to the banks that give them these, or sell them these, or lend them these securities. And what happened in 2009 is very interesting. You see that basically the range of acceptable assets as collateral in loans or outright purchases expanded massively. And so suddenly the central banks were buying basically anything that the banks wanted to get rid of. As long as there was some sort of acceptable definition, it had to be secure enough. But basically, the Fed just put on its balance sheet, so literally bought all of these assets from the banks. And that created a giant injection of liquidity, because these assets are now not on the balance sheet of the banks, but now they're on the balance sheet of the Fed, and the banks have cash instead, and this cash can be deployed and be lent out. Sorry, I'm just checking the chat a bit. Okay, thank you, Luke, for rebroadcasting the stream. Maybe we can send an email out to people to try and hopefully get people to know that this link is there. Thank you, Luke, again. So this stimulus is really important and quote unquote unconventional. We often talk about interesting ways that central banks can affect the economy, and we always talk about lowering interest rate. But here you see that this is a very different approach, and it basically allows to stimulate and make markets that are typically not liquid, when nobody wants these assets, except with a significant discount, then the Fed can step in and really prop up the economy. And again, policy response does matter. Again, there's been a lot of research here, but it's interesting to contrast the Great Recession in 08-09 to the Great Depression in 1929. And you see that actually the first year, we kind of had the same trajectory. And then after 1 year, the Great Recession rebounded, and yet the Great Depression went on for many years afterwards. And it was an unmitigated disaster. Now, it's always hard to claim causality, but I think the evidence is pretty clear that having all these backstops and fiscal stimulus and monetary stimulus help tremendously recover and not have the economy go into a tailspin. Around the world, as I said, we have counterparts. In Europe, we have the European Central Bank, the ECB, that sets the monetary policy for the Eurozone for all of its members, currently Christine Lagarde. And what's interesting is that in 08-09, you see that there was a decoupling. The two zones actually kind of went hand in hand up to 2011. And then the Euro area actually created and went back in a recession in 2012, while the US kind of continued its steady recovery. And the two reasons are actually, typically people point to both the fiscal and the monetary front. And the fiscal stimulus in the US, we had a big stimulus package passed by the Obama administration. In Europe, we had an austerity package, which had kind of disastrous effects, almost the opposite, literally the opposite of what a fiscal stimulus would have done. Made worse by a multiplier effect. I won't go into details, but if you take any macro class, you'll talk about the multiplier effect. When you withdraw money from the economy, then people, there's a ripple effect. And so it hurts more than just the face value. Just like the stimulus will benefit more than its face value, it goes the same in the other direction. And the second reason is at the central bank level. It's kind of interesting. Bernanke and Trichet at the time had a total different reaction, facing similar numbers, high unemployment, but inflation actually starting to spike as they had lowered, as they had kind of gone through this printing press. And what you see is that the central banks actually had very different reaction. Bernanke lowered the interest rates right down to zero, while Jean-Claude Trichet actually raised interest rates, which created havoc and concerns and recession. And just to highlight the role of central banks in a time of crisis, as Europe started to face serious issues, Mario Draghi, who had replaced Trichet as the head of the ECB, saw the yields go up on the government bonds, both in Spain and Italy and other countries at the periphery of Europe. And then he had his famous whatever it takes moment. And you see that immediately the markets reacted very positively and calmed down, and the yields went back down, and basically the risk premium went back down, and the markets were very reassured. And the whatever it takes, well, basically was a massive quantitative easing program, just very similar to the US, where they started buying a lot of assets from the banks and injecting liquidity in these markets. And so that's that. So let's talk about the current crisis now. And so what's totally incredible here is that we have, due to social distancing and trying to stop the spread of this virus, we've literally shut down the economy. This is a nice picture from a shopping mall somewhere in the US. But these pictures can be seen, Paris, downtown London, New York, you name it. These are kind of ghost towns right now. And the recession is going to be deep. This is interesting data that just came out this morning in the New York Times. And you see that in real times with weekly US sales, you see that the obvious losers in some sense, the airlines, the tour operators, Booking.com, the hotels, the hospitality business, Marriott, suffered tremendously here. And so, but this was just the beginning. And now we have everybody literally staying at home, including us, I guess, all of us. And you see that the jobless claims this week came out, 3.3 million, which is literally off the chart. You see that in 2009, we had a little spike in the midst of the biggest recession since the Great Depression. And here we literally have put on pause the economy. And so the scale of it is tremendous. GDP is gonna plummet also to levels that have never been seen in terms of change in GDP, except maybe world wars. How deep is it? Well, again, some perspective, you can see here the Purchasing Manager Index, PMI, and you see that right now it's global, and it's going to go down all the way down to the 08-09 crisis. So this really cannot be minimized. I kind of want to emphasize that. And so thank you. I see a few questions, and I apologize, I haven't answered all of these questions, and I guess we can save some of them for the end. I think that, so we'll talk about unlimited QE, but in a nutshell, I think it's necessary, period. And I thank you for the questions, but we'll see why. We'll see why it's necessary over the coming few minutes. So again, some perspectives, some say, well, it's like the flu or like other diseases we've had, like SARS or MERS. SARS was bad in Hong Kong, and it did take a familiar site in terms of stopping it with the giant reduction in hotel, retail, hotels, flights, and it did have a dip on the GDP, employment levels, and the Hang Seng index, the stock market index in Hong Kong. But ultimately, SARS itself was contained quite quickly, and no pun intended, but there was no global contagion from it. So that offers kind of some perspective. This is a whole different animal, much, much, much worse, in particular because of the great cessation, the great recession that's going to follow because of us stopping the world economy. It is global, and we've seen numbers now coming out of China, and GDP is seeing dramatic drops, and these are the forecasts, but numbers are trickling in now, and we're seeing a gigantic slowdown in the economic production coming out of this country. In Europe, it's the same. The first numbers coming out are horrible, in particular the service industry. Obviously, if all the shops are shut and other service-driven products, then you will see a giant drop. But manufacturing also. So this is really global. Global trade has slowed down dramatically. You see that the US has dropped its exports significantly in the last month. So again, you're seeing some pretty dramatic pictures in these giant ports like Rotterdam, where everything is pretty much empty. Not quite the scene that we used to see in this global economy that we live in. But the question is, even though this is deep, the quick question is, how quickly can we recover? That determines how bad things are going to be. And there, it's hard to look at the past. Every major crisis is different. If you think that we're going to have a 10% GDP drop, which is kind of what we're expecting, these are very rare events. There's been a few, and actually there haven't been any in the rich countries of in recent years. But on average, if you go back all the way back to these big drops, they last 4 years with a very large variance around that number. And the key determinants of the length of it is obviously the damage caused by the initial shock. Are the factors of production destroyed? Are we destroying the factories, or is it just, are we putting a lock on the door and waiting for this to restart? So there's hope on that front. Is there potential fracture the global trade? And we know that the 1930s Great Depression was not helped by a slew of protectionist measures at the time. And obviously, getting the macro policy response right is critical, and that's kind of what we're going to talk about in the next few minutes. I'll talk about the stock market first also. It's a finance, it's Cutler Center. A bear market is defined as a drop of more than 20%. Historically, it can get much worse than what we've seen up to this point. How low can you go? Well, we don't know. We all wish we knew. Again, historically, there's been 14 bear markets since 1929. The mildest is 20%, kind of by definition. The worst is 86%, the Great Depression. And the average has been a loss of 39%. So we haven't seen the end of this. So we'll see. But again, past crises differ in many ways, as does their recovery time. So it's really hard to put numbers here. As economists, this tells us that we have very few data points, so our confidence around them is not that great. What you can just see is that there is high variability. And again, we've kind of just went through the three factors that will affect this, which is the damage caused by the initial shock, the impact on global trade, and the macro policy response. And so I just want to go, before we go into the macro policy response, just look at what the stock market is telling us. It is a critical place for information aggregation. And my colleague Luke will talk about the volatility in time of crisis in one of the coming Friday sessions. But what's interesting is that different sectors are clearly affected differently. The oil industry suffers massively, and if you follow a bit this market, you know that OPEC is also in disarray, and Saudis are increasing production significantly, which has led to a crash in the WTI oil prices, minus 60% since the beginning of the year. And that has led to dramatic drops in valuation in that sector. Airlines and other transportation sector, we know have been hit very hard. They will get a bailout, and we'll talk more about that in a few minutes. Consumer goods and large retailers actually have done relatively well. No surprises. This is what's still open for business here. Clorox, just for fun, is getting a boost there. The gig economy, Uber, Lyft are suffering massively. Obviously, transportation, yet again. Pharma and biotech, it's not all winners here. Moderna is one of the companies that people talk about in terms of vaccines, but it's not clear that all of them will benefit directly from this. Actually, many ingredients necessary for the fabrication of drugs comes from a very complex supply chain with lots of raw ingredients from China, and they've seen significant disruption on that front. What's interesting is that small caps have been hit the hardest. So the Russell 2000 is an index that represents this performance of the small cap firms, of the small capitalization companies relative to the S&P 500. They've suffered much, much more. One of the reasons why is that they do not have the same buffer to withstand a shock like the one we're facing. They're much more leveraged, they're less profitable. And so the markets are efficient. They understand that these are these firms are gonna suffer more in the market than others. And let me just finish this with a fun note. I don't know if you've heard about turnaround Tuesdays, but there's some interesting pattern in the data here. What you see is that whether it's 08 or 2020, if you had only invested from Monday night to Tuesday night, you would actually be up over those two time periods. So it's an interesting phenomenon. It's a bit of a light moment in this talk. It's kind of interesting to, obviously on Monday, there's often a lot of bad news from the weekend that has accumulated. But if markets are efficient, this pattern should not really happen as well. And so I discovered this week. I was not aware of this pattern. So maybe that's where the inefficiency lies. Hopefully this talk will help reduce the inefficiency on that front. So happy Tuesday investing for all of you out there. So let's go to the policy response. And it's not surprising. It's been an all hands on deck approach, starting with the monetary policy that can be adjusted almost overnight. They've had emergency meetings like the FOMC meetings. They've had two FOMC meetings in emergency to immediately reduce interest rates. But obviously for those the most hit by this crisis and who are workers who have to stay at home, and they're not getting a direct benefit from the 0% Fed fund rate, at least not directly. So the fiscal policies are the more direct safety net ways to help the economy, and for instance, sending checks to the displaced workers as they wait to go back to work. But obviously they're more protracted They need approval by Congress, Senate, and the President. And remarkably, we are set to pass the stimulus bill today, which is as fast as I've ever seen in my lifetime. And that highlights kind of the seriousness of this crisis. So monetary policies have already been put in place in a dramatic way. Fiscal policies are coming right now. And so again, monetary policy, you can lower the Fed fund rates and you can provide liquidity to banks and the bond market. People talk about credit easing. And this traditional dual role of central banks of steady growth and steady inflation in times of crisis really it changes a bit. And the goal of the central bank is to ensure a stable market for government debt, prevent a liquidity crunch, and basically avoid a global financial meltdown. If people start panicking and want to get rid of all their financial assets, literally the whole system collapses. So that's the importance of having these QE programs, and this unlimited side of it is to reassure market participants that they will be able to function and potentially keep lending without massive disruptions on their balance sheet and massive losses that could create havoc. So lowering interest rates, again, the other Jerome did it. The fundamentals of the US economy remain strong. That was the first statement. However, the coronavirus poses evolving risks to economic activity. That was on March 1st. And 2 weeks later, now it's confirmed the effects of the coronavirus will weigh on economic activity in the near term and pose risk to the economic outlook. And then they just lowered it to basically zero. And so you see that now we've kind of used the firepower that we had. We're right back down to zero, where Ben Bernanke took us during the financial crisis. Okay, and I talked about quantitative easing, and so it's been relaunched. You see this spike in 2020, and they had actually started unloading, the assets that they had on the balance sheet last year, and now we've seen a giant spike in the Fed basically again accepting all sorts of collateral and buying these assets, or at least accepting them as collateral to borrow money to all the primary banks. And then, of course, in turn, the hope is that the banks now got rid of these assets, got cash in exchange, and can use this cash and lend it back into the economy. So the Fed typically injects money indirectly through the banking system by basically buying assets and paying them in dollars. They're issuing dollars. That's literally printing money. Or they can lend to these banks and accept qualifying assets as collateral. So remove these assets that nobody wants right now off the balance sheet of banks and give them cash instead to prop up the economy. I think it's interesting to note that these lending facilities that they typically extend, usually it's treasury bonds that are held by banks, very safe assets, very, I would say, plain vanilla assets. And what we've seen in the last in this crisis is a renewal, basically a reactivation of the 08-09 tools, and basically now banks can provide a much broader range of securities, and it's not just banks. It's money market mutual funds. It's commercial paper, municipal debt also, and new lending facilities, including direct lending facilities to corporations that can to help them provide liquidity in the outstanding bonds and even issuance of new bonds. So this is a brave new world out there. It's kind of amazing that the central bank is literally opening up its lending window, lending facility to companies directly, and there's more to come. Why these new twists? Well, I think lending has become more disintermediated. The traditional textbook approach is that banks do the lending to companies, but nowadays large corporations issue commercial paper, bonds, and those who provide those funds are not just banks. It's bond mutual funds, pension funds, exchange traded funds, and we've seen them suffer lately. And that is why the central bank has gone beyond traditional bank lending and is now stepping up and helping even bond mutual funds try and accept some of their assets as collateral in these times of trouble. Asset-backed securities, there's fewer of them, but they're still there. And again, there, if you think of an asset-backed security, that means it's backed by it's a bond that would be backed by student loans, mortgages, or credit cards. Well, if those who service these obligations do it out of their paychecks, then you see that we have a problem right now. So they've also opened up a facility to buy those assets. And so we've had our whatever it takes moment here. You see that the Fed announced it on Monday, March 23rd. I believe it's Monday of this week. They had the unlimited QE moment, whatever it takes. And it's interesting, the US markets were closed, but in London, the FTSE 100 was in the middle of its session. It was noon. And you see a giant spike in the FTSE 100 index. And by the time the US market opened, actually, it didn't have that much of an effect. But I think it cannot be underestimated. This is a whatever it takes moment, and you saw what it did in Europe in 2012 when Draghi did it, and it certainly has reassured the markets, and it has worked. So there's all sorts of markets out there. The dollar is kind of a global reserve currency, and there's been a scramble to, flight to safety, a scramble for US dollars all around the world, and that was starting to create some serious issues in global markets. And since some of these tools have been implemented, we've actually seen a stabilization of these markets. And so now let's talk about the fiscal response. The fiscal response has been very strong. You see that on the right here, you see that with these charts in 2020 will be bigger than 08, 09, probably. They still have to be approved, obviously, but people understand that austerity measures is like hitting the economy when it's already down on its knees. And so these are the lessons learned from Europe in particular. And so there's a giant stimulus package that's in the works all over, including the one that we're about to pass in the US. And again, as I said, the fiscal response is not easy. Many people have to agree, and there's been a lot of negotiations really around the clock negotiations here, and we're just about ready to get it done in the US. And what you've seen is a massive stock market reaction because the markets want it. They understand that this is the way that you're going to avoid long-lasting damage to the economy. And we've seen the tremendous rebound this week on the news of these stimulus packages coming through, and obviously the Fed on the monetary front. What should the fiscal response look like? I found an interesting piece from the IMF, basically saying, look, in terms of low-income countries, who obviously needs grants, zero interest rate loans to finance health spending, develop effective vaccines, obviously, that requires public money. Governments should cut taxes, hike transfers for people and businesses that are particularly hard hit. Those forced to stay at home, along with their employers, be offered subsidies. And an expansion of the social safety net, accelerate the payment of unemployment insurance, ease the tax burden on certain particularly hard hit sectors. And what the IMF recommends, the US has done. Basically, if you look at the the rescue bill that is about to pass, a wartime level of investment into our nation, $2 trillion, that's a lot of dollars. And you see that the key elements, I can't go in the details really in this talk, but the key elements are what we expected. So loans and assistance to businesses, small business loans that in many cases will be turned into grants as long as they retain workers. So this is going to be a giant, it's basically carrying small businesses through this crisis as long as they can retain their workers. And so that's a very important measure. And obviously there's for individuals, there's the direct checks that the famous helicopter money that people have been talking about. Also significant improvements on the unemployment insurance fronts. There's an injection to state and local governments and municipalities as they deal with the crisis. There's also a lot of money going into hospitals, FEMA, CDC, pharma research. And so all of that kind of amounts to about $2 trillion, which is truly, truly gigantic. And there's been a lot of critique about these packages. They're done very quickly, very swiftly. I think the document's about 900 pages long, and certainly, some feel that maybe some are going to be at a significant advantage here. Obviously, the airline industry got a giant hit, but they will have a special treatment. In particular, one company that is not named, but is deemed critical for the US economy, and that's Boeing. You've seen the stock go up more than 60% this week on the news of the stimulus. So I won't go into all these controversies. It's fascinating to see all that goes into such a bill. How big is the response? Well, it's gigantic. And just to offer some perspective here, so if we sum up the $2 trillion from this emergency relief package and about $4 trillion from the Fed, that's the size of the intervention of the Fed and the injection of liquidity in the economy, that's $6 trillion. And so just to give context, Obama's stimulus 5 months into the crisis, 08-09 crisis, was 800 billion, so 0.8 trillion, which is, less than 5 times. It's a fraction. It's literally a fraction of the 6 trillion. I guess it doesn't, or it's a fraction even of the 2 trillion if we were just looking at the fiscal portion of it. And the relief package is about 30% of US GDP. And so now we can kind of understand maybe why the stock market jumped so much this week on the news that it would actually be passed very quickly. It's reassuring news to see that the government is basically throwing everything at it, both in the US and around the world. If you look just in Europe, the number of fiscal measures and monetary measures is staggering also. France, Germany, Italy, Spain, and obviously the ECB on the monetary front, they're throwing everything at it also, drop in interest rates, but also all these QE programs, these liquidity programs, these lending programs, lots of government guarantees. Basically, government becomes the collateral for a small or medium enterprise company, meaning it's not the company that's a guarantee on the loan, but it's the government that's backing these loans. These are measures that have been proven in the 08-09 crisis to be very successful in allowing firms to borrow access borrowing at a decent cost in order to continue business. And so, in conclusion, the coronavirus is a pandemic, and combine that with the great cessation that people are talking about. This is the black swan of this generation. There's been massive value destruction in the economy and in the stock market in the less than 2 months due to this unprecedented uncertainty, the risk of global recession, and a threat to global stability if we can't recover quickly. But governments have responded in kind with this whatever it takes kind of moment, learned from previous crises, both on the monetary policies and the fiscal policies, and hopefully that will help. So I will stop here, and maybe we can have a bit of a Q&A. I have more slides, but I'll stop here, and maybe we can have a bit of a Q&A. So. Any questions, reactions? I'm going to unmute. So if you want to, I'm going to allow you to unmute if you want to ask a question or give some reactions. Maybe Patrick, I don't know if you've collected some points that, you know, I'll maybe let you, I've unmuted you.
I have, yes. So there were a couple of questions regarding quantitative easing. Specifically, what are the disadvantages of QE? And if QE had not happened during the financial crisis and banks had been allowed to fail, what would the effect have been on the economy and spending?
I think it's safe to say that the impact would have been catastrophic. I mean, one of the lessons learned in the 08-09 crisis is the Fed let Lehman sink, and that created a tremendous uncertainty. Suddenly there was no more consistency. Who are we saving? Are we killing some banks, saving others? And it created, that's when we saw kind of peak uncertainty in the stock market, in the economy in general. And without the banking sector, there's no more economy. If without lending, everything stops, grinds to a halt. And so I think the QE is 100% necessary, and there hasn't been really a downside to it so far. Obviously, you kind of wonder what's happening to these gigantic balance sheets of central banks, and we saw them unload them last year. Actually, the Fed started reducing their balance sheet, and it kind of created some disturbances in the lending market. So there's been some. It's going to be interesting now that this balance sheet is going to just go through the roof. It's already about 5 trillion, I think, this morning. The long-term effects are going to be interesting, but right now we're in a crisis. So my view is that you have to stem the crisis and kind of offer this reassurance of whatever it takes. The last thing we want is, you know, in macro, I think, you know, the famous words of, you know, the fear of people when it becomes collective it becomes self-fulfilling. And so I think central banks and governments do not want fear to take over. And so this is why they're doing these QE programs, to at least not invoke fear, I would say, in the financial markets. Patrick.
Another question that came in was that so far the impact has been on developed countries which have the wherewithal to inject billions or trillions of dollars into the economy. What do you see the effect being on third world countries?
Third world countries, like in many cases, suffer more. They don't have the same access to capital, and IMF and other international organizations will have to step in to try and stem some of their crisis. So it's not you know, I don't, was there specific countries mentioned? I mean, it's not.
The specific countries were Brazil, Argentina, and Mexico.
Yeah, Latin America. Well, they've had their fair share of crisis, credit crisis over the decades, and so it's tougher. They have less measures, they have less credibility, as a government in terms of, at least when it comes to the financial policies and the fiscal discipline. So I do believe that they will need help. They will need help from other governments and international bodies. Exactly how I see your message. It's Argentina is always on the brink of default, has defaulted many times, and they might not even have the virus. So yes, we'll see how it works. There's a question: should U.S. government take an equity stake in the companies it's bailing out? I think there's different philosophies there. In one side, some would argue maybe they will want to participate in the upside. They also want control, so equity gives you control, especially as a majority shareholder, like they had with GM. So you're in control of the recovery. So I would say I'm not sure it applies, like it's a blanket recommendation, but I would say why not? Actually, Hong Kong had bought back in the Asian crisis more than 20 years ago, had stepped in and intervened massively to prop up the stock market, the Hang Seng, and actually made a tremendous amount of money with their investments, buy low, sell high. So maybe there's a point to be made here, but obviously philosophically, I think, especially in the US, which is kind of the capitalism central, we don't really want government interference to the point of owning or nationalizing some of their champions here. So we'll see what happens. It's going to be political. Patrick, other questions?
I believe those are all the questions we've received through the chat.
Okay. Anybody else?
I have a question. Can you hear me, Jerome?
Yes, I can. Yeah.
This is Jim Spencer. I'm one of the executives in residence with Patrick's course. So I found one of your slides particularly interesting. It was closer to the beginning of the presentation. It was the 10 risks that CFOs had identified as things that they were worried about. And of course, this didn't appear anywhere on the list. Number one, what was the source of that again? And two, do you have any thoughts on how one can go about, whether it's an investor or a CFO, anticipating the unexpected? By definition, it sounds like you can't. But what's behind the thinking that did not move this up on the priority list?
Well, thank you, Jim. So we'll make the slides available and the recording also, so you can go. There's a reference on every slide. There's a reference. There's a link to every article everything is referenced. So you'll have time to go over a lot of Wall Street Journal, Bloomberg, and Financial Times articles. This is actually it's a survey run by North Carolina State University. They've got actually a great website. I think so that's the reference. And to your point, I think, in terms of risk management, we've been teaching, lean management, lean manufacturing, lean supply chain, just-in-time delivery, and we're seeing that in this crisis, this is kind of the worst. Having no cash, all these companies that did gigantic share buybacks and have very little cash on the balance sheet. So there's very little buffer there. So obviously cash is expensive and nobody wants to have too much on the balance sheet, but having a buffer does help. And I think people are now talking a lot about redundancies, building redundancies in your supply chain, building different routes that allows you to deliver your product, even if even if your main router gets blocked, you have flexibility and planning ahead, kind of create war rooms, fictitious war rooms and fictitious scenarios, and see how you would respond. There are many exercises that companies can undertake before it hits, And of course, they need to figure out the scenarios that they think is most likely. So their brainstorming is useful because, again, some of these come from left field, and you don't want to spend too much effort for an event that is extremely unlikely. But pandemic, these viruses, they do come regularly, and there's been quite a few warnings about them. And so you can think of interesting exercises to run for your company. I see a question on M&A. I hope, Jim, that was helpful.
Yes, it was. Thank you.
Sure. I think M&A will dry up completely right now. There's what we call the bid-ask spread issue, meaning many companies probably would want to buy cheaply companies, but the targets probably will never accept a price that is 50% below what was the price 2 months ago, the valuation 2 months ago. So I expect M&A to slow down to a grind. Ironically, the Wall Street Journal was talking about a handshake business, M&A, so not so popular nowadays to do deals on a handshake. So I do expect M&A to dry up completely until this gets resolved. Patrick, I don't know if you can help me out. I see questions coming through on the chat, and I don't know if there's any.
Sure. So one question was, tourism and airlines are very, very important to the economy in Thailand. Is that enough to justify a bailout for the carriers?
Oh, and it's from Ting Ting. Hello. Nice to hear from you. I think it does. Obviously, different countries have very different bankruptcy laws. In the US, it's probably one of the, Chapter 11 allows for a reorganization, and almost every airline has gone through one in the last 20 years, even among the last few, quote unquote, standing. I don't know about Thailand and how a bankruptcy of the major airline would go in terms of disruption of services and sheer destruction of asset value. So I do believe that, in particular with the size of the tourism industry in Thailand, which obviously has been halted but will restart, I think it can justify it.
Okay, another question was, how do you see stability in the EU, where it doesn't seem like many of the leaders can gain consensus on how best to address the issue?
Well, the EU has shown some serious issues in their crisis 10 years ago, and there were some, I would say, major policy mistakes. I think they've learned from it, and they potentially have a lot of firepower because there's both the EU, like the ECB, but then there's also individual countries that can act. Obviously, coordination is always an issue when you see these economic zones. And so can they coordinate efficiently? Are they going to start blocking the borders? There are a lot of questions, and I guess it depends on how long this lasts. If the virus is kind of handled quickly, I think we will probably, thankfully, not have to ask too many questions. If it keeps going on, then we'll have to they'll have to find their moment of union in the face of it. And so, yeah, the EU has actually acted relatively swiftly, and has put a lot of measures into place already. Both, as I had a slide on it, both the ECB and the individual countries have taken significant action, actually.
One more question related to the effects. Assuming that they can stem the pandemic within a few months and everyone goes back to work, can you talk a little bit about the negative impacts of the 2 to 6 trillion in stimulus?
Yeah, that's going to increase our debt load. Thankfully, the US is paying basically zero interest rate on its debt. The Fed, actually, I'm not a specialist, to be honest, in terms of the inner workings of the Fed and the Treasury, but it seems that one is, the Fed is buying a lot of US Treasuries. And so it's kind of one hand is issuing, the other hand is taking them off circulation, which is kind of interesting. And but I think, obviously long-term debt will have to be handled, and there's a lot of questions as to how the US can handle the debt that just keeps growing and has benefited tremendously from being a kind of the currency reserve of the world, which has always led to extremely high demand for dollars, and hence, to some degree, a lower interest rate that maybe they deserve. But yeah, you don't want to see 6% interest on $25 trillion coming over. So I guess we will still see it as a giant win if it's recovered in a few months, then, and maybe the size, it will have been a giant injection, and economy should rebound very nicely, and that should increase taxes, and maybe a new government at some point will increase taxes to boost revenues. And so we'll see how that plays out in the long run.
One last question that I'm seeing here is, or relates to the impact on small business. Any thoughts on steps that they can take in order to mitigate the problems associated with the coronavirus? Yeah,
so you have to read the bill there, and this morning my colleague Paul Grismer was kind enough to actually start going over the details of the bill. We are all involved in startups and other small businesses, and it seems there are certainly ways to access financing for small businesses, and not only financing, not only loans, but loans that can be forgiven depending on the conditions that are met, in particular retention of employees. And so this is literally a grant from the government, and I do hope that small businesses will take advantage of those opportunities that present themselves.
I think that is those are the major themes that I've seen through the Q&A.
Okay, thank you. So maybe we'll leave it at that for now as a first session. I hope you enjoyed it. I hope it was helpful to get a bit of a big picture of what's happening. It's happening in real time, and so we're there trying to take the pulse and report it back to everyone linked to Babson and the Cutler Center. And thank you again, Patrick, to the Cutler Center for hosting this. And I look forward to seeing you all the coming Fridays with my colleagues taking over and looking at other aspects of the crisis. So thank you very much. Okay, all the best, everyone. Have a good weekend. Take care and stay safe, and practice social distancing.